Hi, this is Scott Murray, and welcome to the Daily Economic Market Shout for Tuesday, May 9th, 2023. It's great being with you here today. Today, we're going to talk about small business optimism. It falls to the lowest level in roughly 10 years. Why? Well, expectations of the economy. Probably the most expected recession in U.S. history is expected, I should say, again, to be upon us as the year comes. And small businesses are reacting to that. They expect their earnings to fall. And that's how they're trying to plan out their business cycle. But curious again, and we've seen this in the ISM numbers, and we obviously saw it last Friday when we looked at the employment number. They're not willing to lay off people. They're not willing to take that drastic step of saying, hey, I think we've got too much inventory. I think we have too little demand. Okay, you're out the door. Good luck. Thanks for participating. They're not doing it. And why are they not doing it? Because I think that the expectation of hiring is so severe. Now, what does that mean? I think that means that when we finally get to the weakness, we will see a sort of a modest change. And again, I drive back to what we saw in the ISM numbers. We saw companies reporting lower new orders from existing customers, but they saw an increase in new orders from new customers. And I think as the economy is going through another one of these creative adjustments that we've seen, I think it's going to focus on different sectors. And that's where I think the banking crisis will not have a big impact as people expect. Why? Because there's a lot of financial disintermediation that goes on. And because of that, different intermediaries show up and they provide different products. And that's really the history of the finance sector. You go back to the community bank 50 years ago, you then move to sort of the specialty lender. What happened, right? Credit card companies didn't just appear mystically. What happened was that banks had credit card facilities. We saw, one of the first card was obviously the Bank of America was a leading provider, Diners Club, and those types of things. So they actually had kind of a market, and we saw disintermediation. We saw companies come to fruition because they were just focused on one product line. We've seen that in specialty finance. We've seen it with equipment financing, and I do think again we're going to see that moving forward. Right, great financial crisis. We saw the model risk become forefront. No, not expected. The Fed wrote major papers, took about 10 years to sort of figure out what they really wanted to do with model risk. And that created a lot of stress on banks because they didn't really know what they were being measured against. And therefore, I think we're back to that game again for the larger banks. I think they're going to struggle. They're not going to be able to be as competitive and they're not going to be as innovative, but someone will pick up that ball and they will move that forward. And so I think that's another element that we have to look for small businesses. I think, remember, a lot of small business lending comes through the government in the SBA loans. Those are really just repackaging. And remember, there's a ton of small, mid-sized, even mutual banks that are sitting out there and more than willing to pick up some of this business that, maybe the more for-profit, the more, market-oriented, more stock companies don't really want to take. So banking is a huge, diverse business. Its component is the finance sector, and there are many components of the finance sector that can step up and take the plate away from the banks. So yeah, I think the Fed is right. I think that higher standards are going to weaken some elements of the economy. And again, I think we're seeing the standards being tightened. These are not surprising elements, but is that making a small business owner fire employees? Not yet. Will it as we go forward? Yeah, it's really hard to tell. And I think that's one of the things we're going to have to be leery of. particularly when the chair, Powell, notes that he doesn't really think we might have a negative print on a GDP, on employment, even though we're having economic weakness. So more to come in this story. Cross currents are there. These cross currents, I think, will continue to affect small businesses. Good news in the numbers that we did see some price weakness. That'll give them a little bit more of a buffer as the economy, kind of meanders in the next couple months, as long as, and I think you'll see the equity markets sort of meander with it along. And I should say the bond market too, sort of looking for direction, looking for, kind of where we're moving. But I think one thing is, as we get to the end of this year, we're going to see further economic weakness. Does that become a full-fledged recession? Probably not, but yes, there probably will be 2 prints in a row, and we can call it a downturn. And I think what you're going to see in the inflation numbers is that come in too, which is a little uncharacteristic as a later part of the economic cycle. This is Scott Murray. Have a good day.